Welcome to episode 1 of the Property Roundup, Monday 22nd of January 2024. We've got a jam-packed episode 1 for you. For those who don't know, my name's Arnold, your go-to mortgage advisor and your host for today. I've got tons of things that I want to get through today, so I'm going to make sure it's all worth your while. So let's get straight into the show. Now, in today's episode, we're looking at quite a few things. Interest rate reports. So we've had lots of rates slashed, and I have to be honest with you, my phone has been going absolutely crazy. I've had emails, text messages, all sorts of alerts and calls letting me know about products being added to the market, taken away. It's an exciting time in property. So we're going to get into that in today's show as well. 40% of property buyers got a last minute discount before Christmas, right? That's another segment we're going to get into. And this is a thing, right? So if you're somebody who's a first time buyer and you are new to the market and you've never kind of gone through the house buying process before, you might not have the experience and context to know the difference of what is happening right now compared to maybe 18 odd months ago, right? But for those who were looking for properties, let's say 2 or more years ago, right? You will realize the difference in the sentiment of the market right now and how much of an advantage there is for people that have got a bit more of an awareness on the opportunity and how to go about it to get a great discount. So we're going to get into that in that segment, talking about how you might be able to secure some of these major discounts on your next purchase too. And also we're going to be doing the segment talking about answering your questions, right? And the question for today is, how do I stop the estate agent from tricking me into overpaying? And believe me, this one is one that is close to the bone, because the reason why it's so close to the bone for me is because both based on the things that I've learned through my own personal experiences, the buying experiences of people around me, and even more so our clients, right? We deal with a lot of first-time buyers, and so they don't necessarily always have the context to know who the estate agent is, what their interests are, and the fact that they don't actually work for you, they work for the seller. So I'm going to be getting into that in that segment today, just to give you a few pointers on how you can make sure that you don't end up overpaying, but you can actually start playing things in your favor so that you get a good deal, right? So let's jump straight into today's episode, starting off with the interest rates report. Now, you've probably seen it in the headlines. You've probably seen it if you're somebody that's actually in the mortgage market, but rates have finally been continuing to come down, right? And obviously, I mean, we're not in the days where you had the sub 2% interest rates, right? We're not there. I get it, right? And for some people who are holding on to that experience and waiting for those days to come back, you might be waiting a very long time, right? But the main thing I want to emphasize in today's interest rates report is to give you a quick update, number one, give you some commentary, and to hopefully give you some quick ideas on how you can navigate making choices on which products you're going to go for. And that's whether you decide to go through a mortgage broker like myself or our team, or if you decide to do it yourself, right? As always, because our firm is an independent whole of market firm, that means that we don't just compare a handful of deals from maybe 5 to 10 lenders like some mortgage brokers and advisors do. We have access to the full mortgage market, which means that we compare thousands of deals from over 100 lenders across the whole mortgage market. So what that means for you is that the deals that we talk about are going to be examples of some of the deals that you might not have even heard about, and possibly even deals that you might not be able to access directly yourself. But ultimately, it's about helping you to find some of the best deals out there today, right? And it's worth saying this segment is not sponsored, nor is this episode or this show sponsored in any way by any of the lenders mentioned. We are 100% independent in our choices and who we mention. It's just about sharing some examples of deals that will help you on your potential search, or somebody else that you know as well. And lastly, of course, before I get into some of these rates, it's important that I say that everything is accurate at the time of recording. Rates are constantly changing. Products are added to the market, withdrawn from the market. So if you do end up searching for any of these deals and they're no longer available, it might be a sign of how quickly the mortgage market moves, right? So let's dive right in. Okay, so first-time buyers, if you're looking for a 5-year fixed rate deal, winning the race today with the headline rate, we have Virgin Money with a mortgage product at 3.92%. Now, before you quit this episode and go run to apply for this mortgage product because you heard that it's the lowest rate available, make sure you stay tuned to the end, because even though it is the lowest rate available, there are certain situations where this might actually not be the best product for you. And I'm going to get into some of those examples a little bit later, so make sure you stay tuned to the end. Now, when it comes to the 5% deposit corner of the mortgages, Danske Bank, who you may not have ever even heard of, are one to keep an eye on today. They're coming in with a 4.86% deal that might have your attention. Now, it's worth mentioning that when I was preparing for this video, the cooperative bank had a 4.48% product that was a bit more appealing. But sadly, as with the mortgage market and how fast things move, they withdrew this product on Thursday, the 18th of January. And it's just another reminder of how quickly things move. And that's why you have to really stay on top of things and have the right systems and processes in place to get the best deal. So take the lesson from that. Don't sit on the fence if you find something that seems like a good deal today, because there are ways you can secure it and still benefit if a better deal comes up later on. And I'll come back to that later on too. Now, moving on to 10% deposit mortgages. Again, up until last Thursday, the cooperative bank actually had a product at 4.12%, but this was also withdrawn from the market. We then had Danske Bank trying to take the lead with a 4.41% product, but Virgin Money came and put them in a headlock with their 4.38% mortgage rate. Now, quick sidebar. A big part of this segment is about helping you to make better decisions when it comes to choosing the right mortgage product for you. And so to kind of give you a feel for this, I want you to take a look at the 3 products on the screen and the ones that I've mentioned if you're listening audibly. And I want you to think, if you had all 3 of these products lined up and you had to choose one to apply for, which one would you choose? Drop a comment with your answer. Now, with that said, a lot of people will no doubt choose the Virgin Money product because as far as they can see, it's the lowest interest rate on the screen. But this is the thing, you have to look beyond just the headline rate because there are so many other variables that can mean that the mortgage deal that has the lowest interest rate might not actually be the best deal for you when you do the full comparison. And here's why. Starting off with the headline rate that Virgin Money has of 3.92%, when you look past just the interest rate and you start digging into some of the criteria and variables that come with the particular deal, first up, you need to have a 35% deposit to qualify for this deal. If you've got anything less, you're not going to qualify and you won't be able to access this rate. And that's even if you have a perfect credit score, a perfect application. If you ain't got the 35%, it's not going to be for you. There's also a valuation fee payable up front. Now, the cost for the valuation fee will vary depending on the property's value. And on the bottom end, it could cost £112 all the way up to £970 or even more if the property is valued at 3 million or more. But if you're buying a 3 million or more property, I'm sure you're not going to be worried about a fee like that. But if this is a product that you're considering and maybe you have got the 35% deposit, it's important that you know that this is not a fee-free product, which for some buyers is extremely important. And the other thing to note about the valuation fee is that if for any reason the survey is done, the property comes back unsuitable, or any issues arise that calls for the surveyor to say that the property should not be mortgaged, that's your money gone. And this is where you really have to weigh up whether it might be more worthwhile going for a product where there's a free valuation if your budget's a bit more tight, even if it means taking a slightly higher interest rate, so long as it's affordable. So fast forward, maybe you've got a 35% deposit, maybe you're even happy with paying the valuation fee, but something else that you need to know about this particular product is there's an arrangement fee for £1,295. Which for some of you might not be an issue at all, but for others, the point here is to make sure that you account for all of these things within your budget because you don't want to end up applying for a product that you haven't got the money to fund. And on a positive note, this deal does also come with a £500 cashback incentive. So what that means is if the mortgage does go to completion, i.e. the mortgage is sorted out and you get the keys to your brand new home, Virgin Money will pay £500 to your solicitors as a nice little gift on the end of the completion. So there's a nice incentive. Now let's break down the 5% deposit 5-year deal from Danske Bank. So number one, you need to be looking for a minimum loan size of £150,000 if you're a first-time buyer interested in this deal. So for context, when you do the maths, it means that you need to have at least an £8,000 deposit if you were to take the very bare minimum loan size of 150k. And when you do the maths and add that together, it works out that you have an approximate purchase price of around £158,000. So if you live up north or anywhere where properties are significantly cheaper than £158,000, then this might not be the product for you. Now for the next requirement, let's talk about energy performance certificates, also known as EPCs. For those who don't know, an EPC is a legally required survey certificate which essentially grades a property from A to G on how energy efficient it is. So if it's a super energy efficient property, it will be graded somewhere near the A range. If it's a terrible property for energy efficiency, it will be closer to the G range, and it can fall anywhere in between based on a number of factors. So with that context, this particular mortgage deal is only available for properties that have an EPC rating of between A to C, and it has to be an A to C at the time of the application. Now, what most people won't realize is that across England, the average property EPC rating is a D grade. So bearing that in mind, that should give you some sort of indication on how many properties might not actually qualify for this deal. Number 3. Now, for those of you who heard me talking about the EPC requirement and you thought to yourself, I'm going to be the smart one, I'm going to go out and get a new build. That's how I'm going to get an A to C grade rated property to qualify for this deal. Bad news for you, because this deal is not available for new builds. So make sure you keep that in mind if you're thinking about this deal. But on a more positive note, this deal does actually come with a free standard valuation. And that's positive to know, because if for any reason the property transaction falls through, you don't have to worry about losing your valuation fees. Now let's get into the 10% deposit 5-year fixed deal from Virgin Money. First up, it's important to mention that Virgin Money is targeting somebody who has a good and strong credit history when they're looking at this product, ideally free from any blips on their credit history. So if you're an applicant who has adverse credit, then you might have a hard time trying to get this deal. For example, if you've had 2 months arrears in the last 6 months, it's likely to be a no. If you've had more than 2 defaults, it's likely to be a no. Or if you've had any defaults in the last 6 years that are currently unsatisfied, you guessed it, it's likely to be a no. So these are a few things to consider if this is a deal that you're thinking about. Now, another thing worth noting is if you are looking at new build properties, these can be considered for this deal. But if it's a new build flat, you're going to need a 20% deposit. If it's a new build house, you're good with the 10% deposit. Now, this deal does also come with a £1,295 arrangement fee, so make sure you count that within your budget if you're thinking about a deal like this. And once again, there's also a valuation fee payable up front, so make sure you do your due diligence to work that out. And if you want, you can skip back to what I mentioned about the previous Virgin Money deal, because it's calculated on the same basis. Perfect. So for those who are looking for non-first time buyer mortgage deals, here are a couple more deals that you might be interested in. First up, we've got for residential homeowners looking for a remortgage, Santander is leading the way at the moment with a 3.89% product. Now, the maximum loan to value for this particular product is 60%. So what that means is that for this deal, you'll need at least 40% equity within your property. And let's actually talk about that for a moment, because some of your favorite property influencers and gurus never prepared you for this. Because up until early 2022, a lot of their advice was about refinancing your property to the maximum value so that you could make more tax-free money, go and buy property, quit your 9 to 5, escape the rat race and become a property millionaire. Now, I say that lightheartedly, but the thing is, yes, people can make money in property, and yes, to some degree, there are ways that you could leverage techniques like that, which I've done myself. But if you follow that kind of advice blindly without having any sort of risk management in place, you'll find that, like tons of people who actually did this over the last few years, they're absolutely stuffed in the market like now. And the reason for this is because if you keep on remortgaging constantly to the maximum value, then when the market does turn around for any reason, interest rates go up, property values start going down, when you come up to do your next remortgage, you might find that you're in negative equity, and that's because the value of the property is lower than the debt that's outstanding. So if you are a property owner, or you're someone that plans to own property, then don't make the mistake of just refinancing to the max and thinking that it's just going to be something that's going to take care of itself. You have to keep in mind good risk management strategies, approaches that will help you to strategically prepare for worst case scenarios like the market that we've currently been going through. And this is something that we're seeing with some of our best performing clients, right? Because they've taken advantage of refinancing as appropriate when the market was right, but they've left enough room so that they haven't refinanced to the max, so that when the market does turn around or property values are going down, interest rates have gone up, they've had enough equity within their property to be able to stomach some of the difficulty that's actually squeezing a lot of people out of the market right now. So back to the Santander 3.89% remortgage for residential homeowners. This deal is also a 5-year fixed term, and it does come with a $999 booking fee. Now, worth mentioning about the booking fee, that can be paid up front, but here's an important key for anybody that's considering this product. With the way that mortgage rates are constantly changing, you need to be on the pulse so that you don't end up overcommitting to a deal that might not be as efficient for you as something that comes out later, right? And so there's 2 ways you can play it if you wanted to take a product like this. You could pay the fee up front, and if another deal came up either with the same lender or someone else and you wanted to pull out, you'd probably have to go through a lengthy process to try and get the refund of any fees paid if you haven't gone too far into the transaction. But that might not be helpful, especially if things are tighter on the finances and you want to be able to use that money and put it into something else straight away in the meantime. The other option is that when you submit your application, you can request for the fee to be added to the loan. And the benefit of doing that is that you have the opportunity to secure the good rate straight away, whilst also having the flexibility to take an alternative deal with the same lender or somebody else if it comes up before you get too far in the transaction. And going back to the fee that you've added to the loan, let's assume you do go ahead with this deal and you stay with the same lender. When the mortgage completes, as long as you pay off the fee within 21 days, you won't be charged any interest. So it's a way you get to defer the payment without having to incur any interest, but still have the flexibility of looking for a better deal. Now, buy-to-let purchases and remortgages. TMW, the Mortgage Works, is definitely one to watch for this one. They've got a headline rate at 3.84%. Now, with this particular product, the maximum loan to value on this one is 55%. So again, that might not be accessible if the difference between the debt on your property and the current value does not have enough room to qualify you for this product. Now, this is also a 5-year fixed term deal, and it comes with a 3% arrangement fee. And this is where, as a savvy buy-to-let investor, you really have to be on top of your numbers, because if you are going to pay that 3% fee, you have to start thinking about how long it's going to take for that money to be paid back. How does that affect your return on investment? Is the property going to be cash flowing so much that it makes that 3% seem insignificant? These are the kind of things you really want to be thinking through when you're crunching if this is actually the deal that's right for you. And lastly, for first-time landlords, this deal is only available for you for new purchases. Okay, so on to the next segment. We're going to be talking about 40% discount for buyers, right? And there's an article that we're going to pull up, right? Apparently, 40% of property buyers got last-minute discounts just before Christmas. How did they do it? Why did this happen? Let's take a quick look at the report, and I'll share some things on what I think personally and what I've even seen with some of our clients who have been really taking advantage of this too. So nearly 40% of property deals featured gazundering before Christmas. It says a spike in gazundering has been reported, particularly in the south of England where house prices are higher. House buying firm Quickmove now says 39% of the properties it sold during November were subject to gazundering, up from 13% the previous month. And it says that the company has not seen gazundering at this level for 16 years, with quarter of deals affected last month. Now, here's the deal, right? You have to think about what's actually going on here, because we're in a situation where in recent times, mortgage interest rates were going up and up and up. The property market changed from being a seller's market to a buyer's market because supply was now starting to outweigh demand. And as a result, it means that unlike in the pandemic and post-pandemic times, where a property went on the market today and was gone on the same day and things like that and had multiple offers on it, you now have situations where offers are being accepted by sellers, and close to exchange of contracts, the buyers are coming back with good reasons to justify why they no longer feel like paying the price that they were paying before. And I mean, this is the thing. It's tough to think about, because I can imagine how some of the sellers could be in really difficult situations, and for all sorts of reasons, every pound and penny counts towards the sale. So there's definitely a side to it where you can understand the hurt and the upset. The reality is, it's a business transaction, right? Whether it's somebody that's buying a home to live in, or if it's somebody who is buying an investment property, we all want the best deal, right? And given the opportunity, we'll all take the opportunity to get the best deal possible. It's the reason why you have people like us in business, because we have clients who are constantly looking for the best deal for their situation that's going to help them in the long run, right? And so, bearing in mind the context that we're in, you can understand why it becomes a lot easier based on the demand and the supply for a buyer to potentially get a discount, right? Because if your property has been on the market for the last few months, already there's a sign that either you've had offers that have fallen through, or there hasn't been enough interest to carry your property from offer to completion, right? Your property is growing stale in the market. These are kind of indicators to show a potential buyer who's paying attention that, maybe this property is overpriced. Maybe there's something about it that would justify why the price that it's listed for is not what should be paid. I mean, all you have to do is take a look at Rightmove to see the number of properties that are reduced. I mean, there's properties that I have seen, prime properties, where you have multiple estate agents competing to sell the same property, right? And even more so after a property was listed as sold, and then several weeks or months down the line, it goes back on the market and all of a sudden you have multiple agents competing to sell the same property. You see Rightmove talking about reduced prices. It's very common. There are certain tools that you can use to access historical prices, right? Properties that have been relisted by agents, right? There's a lot of things going on to indicate why right now is definitely, in many cases, a buyer's market. And bearing that in mind, it's about being smart and knowing which levers to pull and what the right information you need to play with in order to justify getting a better deal. And so just a word to our first time buyers and some people that might not have as much experience in the property space, do not let the estate agent trick you into overpaying. And I'm going to come back to this in the next segment, but it's important that when you are buying a property, if you're looking to put in offers, you need to separate your emotions from your offers. You need to understand the climate we're in, and you need to really do the work to understand the seller's position, because it's the person that has the most information in the negotiation who usually wins. So the more you understand about the seller's situation, what is it that they're looking for? How much debt do they actually have on the property? Have you even gone to the land registry to check out that information? How long have they held that property for? Is it a probate property and likely to be mortgage free? Like, these are all some of the factors you really want to be thinking through, because the more you know and understand about the seller's position, the better position you put yourself in to get a good deal that makes sense for both parties. Okay, so we're on to the last segment of the show, and we're going to talk about beating estate agent tricks. Now, we deal with a lot of first-time buyers, and we prepare all of our clients, first-time buyers or not, with what to expect when they're going through the house buying process, right? Now, this segment, it's important to say, is not about bashing estate agents in any way, shape or form. I've got a few friends that are estate agents. There are estate agents I've worked with over the years and I've had great relationships and experiences with. But here's the thing that you need to know as a buyer. This is a business transaction and everybody has an angle. The more you understand about the different angles of the different people involved, the better you position yourself with the greatest chances to maximize on securing a good deal without overpaying. So let's set the scene a little so this makes a bit more sense. As a general rule, who does the estate agent work for? Who pays the bill for them? Who is the estate agent's customer? Is it you or is it the seller? It's the seller. So no matter how friendly the estate agent may be, they work for the seller, and their job is to sell the property for the highest possible price. And this is where you have to really understand that in most cases, it is in the interest of the estate agent to sell it at the highest price possible, because their commission is directly linked to how much they sell the property for. Now, there will be some exceptions based on different ways that different estate agents structure their service, but for most people, this will be the case with the estate agent you're dealing with. So knowing this, you have to be really smart about how you go about that relationship that you have with the estate agent. And as a rule of thumb, you want to keep it professional. Don't tell the estate agent information that is going to compromise your buying position, i.e. things like, I'm so in love with the property. This is the only property I want. My hopes and dreams lie in buying this property. Look, you don't want to give them any more than the essential information, because if the estate agent knows that you're over invested in the property and that you maybe don't have many other options or choices, then they'll do what most of us will do to you in a business transaction. They will use it as an opportunity to sell for the maximum price possible, knowing that you've got your emotions involved. Make sure you put all of your offers in writing, even if you've spoken to them on the phone, because you always want there to be a trail and a track record of when your offer was logged and when your offer was sent, so that nothing ends up coming back to suggest that your offer was either not made or was made at a time different from when it actually was. Believe me, we've seen it all. So that brings us to the end of today's show. If you've got any value from this episode, then make sure you hit the like button, subscribe wherever you're listening, leave us a rating, because these are the things that really help us to go further. And in fact, do us a favor, please make sure you share this video with somebody else that you know who either owns a property or who wants to own a property and could do with the extra information and knowledge. And lastly, if you're looking for tailored mortgage advice and you want help with arranging your first or your next mortgage, then make sure you get in touch by either emailing me at arnold@theinvestedmortgagebroker.co.uk or give us a call on 0203 790 8567. With zero fee, our service won't cost you a penny and you won't end up paying any more using our service than you would if you went direct to a lender. So you get the benefit of knowing that you get access to the full market to make sure you get the best possible deal for your situation, and it's not going to cost you a penny. So do get in touch. And if you are a good fit, we'd love to help you with getting your next mortgage deal. Take care, and I'll see you in the next episode.